You went to bed with plenty of buying power. You woke up and it was gone. You didn't make a single trade. Your positions didn't change. Your strategy didn't change. The market did, and the broker reacted. Buying power is a risk limit imposed by your broker. The broker has the final say, and they don't need your permission to change it. To the everyday person who doesn't trade, buying power just means whatever is left on a credit card. If the card works, that's all there is to it. But for a trader, buying power is entirely different. It isn't spending power. It's a risk limit imposed by your broker, and the broker has the final say. That limit is not fixed. It can change without notice. Buying power exists for one reason. It exists to limit losses, not to maximize returns. It protects against losses that accelerate too quickly, losses that occur across correlated positions, and losses caused by volatility expansion or sudden gap moves. Buying power is the broker's defense mechanism. It is not a convenience for the trader. It is a control system. Here's where traders get this wrong. You open a trade. At entry, buying power looks manageable. Nothing feels urgent, but buying power is dynamic. Volatility increases. Options reprice. Risk rises quietly. At the same time, your broker's risk systems reevaluate exposure. They are measuring how fast losses could accelerate, how positions interact with each other, and whether multiple trades could fail at the same time. This is where correlation makes everything worse. If you hold multiple positions in the same sector or theme, the broker does not see diversification. Different tickers do not mean different risks. When those positions move together, the risk system treats them as one big trade. That correlation creates drag on buying power. Even when trades look small, when the models update, margin requirements change, often without notice, sometimes overnight. You can go to sleep comfortable and wake up with buying power consumed. The trade didn't change. The rules did. So what is considered a safe buying power ratio? It depends on the product because margin behaves differently in each one. For stock options, which are most exposed to sector correlation, conservative traders use 20 to 30%. Moderate traders use 30 to 45%. Above 50% correlation risk dominates. For SPX index options, correlation is lower, but margin is volatility driven. Conservative usage is 25 to 35%. Moderate usage is 35 to 50%. Above 55 to 60%, volatility spikes can consume buying power before price even breaks. For NQ and futures options, leverage is highest and margin changes are fastest. Conservative traders stay around 15 to 25%. Moderate traders push 25 to 35%. Above 40%, margin calls are no longer rare. They are expected. This leads to the sizing rule that matters most. Never size your account for a normal day. That mistake ends accounts. Always size for volatility expansion. Always size for correlated moves. And always size for overnight margin changes. If a bad but reasonable day would force action, you are oversized. Buying power is not about how many trades you can open. It's about whether you can still adjust, wait, or reduce calmly when conditions change. That's what buying power is really about. Remember this, it's not conviction, not confidence. It's all about control of exposure. If you don't control buying power, the broker will. If any of this information is of value, please subscribe. And always remember our motto, math makes money.